How's it going, everyone? It's Sam. I'm doing something a little bit different today, which is telling you about my stream of income that I'm building right now that should pay me $3,000 a month for the rest of my life. And I'll kind of walk you through what I'm doing. But if you've been a long-term subscriber on the channel or a long-time subscriber, you've probably seen that I've been investing in a dividend portfolio. Now, I've been talking about penny stocks a lot recently. I talk about a lot of growth stocks, and just to be honest, that's partly because that's what people want to see. That's what people watch. And this is my full-time day job. So I want to incorporate every type of investing into this channel. I talk about cryptocurrencies. I talk about dividends. I talk about long-term holds. I talk about penny stocks. I talk about growth stocks. I talk about everything. So I just wanted to hit on something that I haven't talked about in a while, which is my dividend and income growth portfolio. Now, this is not something that is really hard to start by any means. What I'm doing is I'm investing $100 a week, which I realize for some people is a little bit of a stretch. I realize for other people that's not nearly enough for what they want to accomplish. So I think that this is a good amount to put in because it's a solid amount that it just is consistently investing into this portfolio. And by the time that I'm 60, I should have about $1 million, which should return me about $3,000 a month in this portfolio. Now, I'm going to walk you through every part of it. I want to talk to you about dividends in general. If you don't know too much about them, I'll walk you through one of the companies that I hold and kind of some stuff that I look for in dividend companies because I've had some questions on that too recently. So if you guys like this, please leave a thumbs up. I appreciate it. Let's get dividends back, in the mix for YouTube. A lot of videos that have dividends in them don't get viewed very often. People just don't care about them right now. It's not the sexy thing to get dividends like it was a year or two ago, according to the YouTube algorithm. So let's hit the like button. Share it to someone that you know that maybe they're young. Maybe they want to invest in dividends. Now, there's a time and place. Usually people will tend to go towards growth stocks early on in their investing career. But I think having a small portion of your portfolio as a dividend growth portfolio just to maybe nail down some of the normal expenses of your daily life. Like if you know that you're going to have a mortgage payment, try to get up to whatever your mortgage payment is in dividends. It's just steady. But it's always a risk reward that you have to weigh there. So we're going to talk about that. If you guys don't mind hitting the like button, please hit subscribe if you haven't done that already. We're getting very close to 100,000 subscribers, and that will make my day, that will make my week, that will make my month when we do that. If you guys want to know exactly what I'm buying and selling, there's a link down there to Patreon. I buy stocks almost every day, maybe every other day, but I've been buying a lot of stocks recently. We've been doing really well between the dividend portfolio and just my normal investing stocks, my growth stocks. You can check out that link down there. And if you want, there's a link down there to WeBull where you can get some free money if you deposit $100 and start investing on that platform. Or you can start with M1 Finance, which is the portfolio that I'm using here today. You can see that I have a very steady amount of money going in here because I put $100 in every week. And then I also put money into my Roth IRA in here. And these are two long-term portfolios. M1 Finance is really good for long-term investing. So if you want to check out the link down below, I would really appreciate that. So this is the dividend and income growth portfolio. You can see that we have a good gain here since we started this portfolio. We've earned about $32 worth of dividends, and this is only going up. So you can see our portfolio balance over time. This was started back in July, and it's just steadily increased. And you can see my entire portfolio here. It's adding a lot to the same stocks because I feel strongly about these stocks. You can see some I've added more to than others because they're all at different values. But I want to kind of walk you through what I'm thinking. So I constantly reinvest into these stocks because I feel so strongly about them. JP Morgan Chase, Store Capital, Disney, Foot Locker, AT&T, Realty Income, Innovative Industrial Properties, and Qualcomm. So all these stocks pay dividends. And the theory is you can reinvest your dividends back into the portfolio, and that's what's nice about M1 Finance. It actually can reinvest for you. You can turn on auto invest, and it will just reinvest into however you want to allocate your funds. But you can reinvest your dividends, and it's just a compounding effect. Now, for me, again, if I do $100 a week into this portfolio, if I deposit $100 a week, I have $3,500 now. I'm 25, so by the time that I'm 60, I should have about $1 million, which should return me anywhere between $2,500 and maybe $4,000 a month or something, depending on how much these stocks yield by then. Now, something that's interesting about dividends is they can actually increase dividends over time. And if you're able to jump in on a stock when the value has decreased, you get a higher dividend yield, as they call it. So a company issues a dividend whenever they have extra cash and they feel like they want to reward shareholders in a way of literally giving them some of their earnings back in the form of cash. So they can either reinvest into the company, they can buy back their own shares to increase earnings, they can give dividends, or they can acquire other companies. There are a handful of different things they can do, but these companies pay dividends. They also reinvest in themselves. So you have to find companies that, really the most important thing is you find companies that are growing and are able to increase their earnings, right? And you also want companies, if you're looking at a dividend portfolio, that want to increase their dividends to their shareholders. They don't want to just keep 1 cent dividends for the entirety of the company. That's not the goal. You want to get larger and larger dividends over time. Now, back during the pandemic, we were able to pick up some of these stocks for a very cheap amount. And because the dividends stay relatively the same, right? They don't go up and down with the share price. They stay about the same. So let's say JP Morgan Chase costs $130 today, but back in the pandemic, they only cost maybe $80. So if they're paying out the same amount of dividends, you could buy it for a lot less money and get the same dividend, and that would be increasing your dividend yield. Now, some stuff that I look for in these companies. Store Capital is a company that we're looking at today. I hold this in a couple of different portfolios. And this one's interesting because it's known as a REIT. It's a real estate investment trust. Now, REITs are different than a lot of these other companies, but I'll draw some parallels. So I have several REITs in here, and what they are, they're a collection of real estate investment properties that are under a company's name. Now, something that I like to see in all of these companies is increasing revenue. Now, this might be thrown off a little bit because of the pandemic, but you can see here, I like to see increasing revenue. If there is something that came up, maybe the revenue decreased, I want to know why. I want to make sure that it's still a growing company. But you can see here, it's consistently increasing year over year. Something else that I like to see is and again, I look a little bit more in depth than this, but I want to just kind of cover some of the main points with you guys. Net income is increasing. Net income is the income after, everything comes out essentially. And these are not textbook definitions by any means, but this is really the earnings that they have after everything is paid. And this I want to see increasing. I want to see them become more profitable over time. But what's interesting about real estate investment properties and real estate investment trusts is they can essentially have a share offering, right? They sell more shares, or they offer up more shares to get more capital than to buy more properties. So you have to be careful, because if they're doing this, it would only make sense that their revenue and net income would go up because they're buying more properties over time. So you can't just look at this. You also have to look at their funds from operation. And I really break this down to funds from operation per share, or AFFO per share, because they also can show some different financials. For example, FFO refers to the figure used by real estate investment trusts to define the cash flow from their operations. Real estates and companies use FFO to measure operating performance. So this is calculated by adding depreciation and amortization to earnings and then subtracting any gains on sales. So you could have the sale of a property and that could throw off your financials. You could also amortize or depreciate, and this can throw off the different numbers that we talked about before, earnings and revenue. So you have to be careful. Now, you can also look at AFFO, which is the FFO and subtracts any reoccurring expenditure that is capitalized and then amortized. So you can search these a little bit more in depth, but I like to see these go up over time because I want to make sure they're not selling properties or something like that behind the scenes to increase their earnings or their revenue. So I like to see these increase over time too. And you could break down per share so that you make sure that they're not just increasing the number of shares out there, but you can see these are increasing too. Both of those are increasing. Something else to look at, balance sheet. I want to make sure that they're in a good financial position. One way to do that is looking at the current ratio. So you take a look at their cash and cash equivalents, and then you put that over their current liabilities. So for example, on this one, you can see cash and cash equivalents, 144 million. They also have 177 million of accounts receivable, just something to keep in mind. Other current liabilities, about 94.8 million. They have a decent current ratio. It's about 1.5, so nothing really alarming. And then also you can take a look at cash flow. How much money do they have for reinvesting, and then also for dividends. And we'll put this one up here, and then we'll look at the dividends themselves. Free cash flow per share is pretty much going up. You can see the last year it actually went down a little bit, just the trailing 12 months, most likely due to the pandemic. But you can see before that it kept on increasing. Now, you want to look for some kind of X factor. I like to look for some kind of X factor that makes these companies different. For example, store capital rents to actually less qualified tenants, and by that I mean they're not the biggest companies out there. They're not the Starbucks of the world, which gives them a competitive advantage actually, because a lot of people wouldn't consider this, but because of this, they're able to get a little bit higher revenue for that. So they're able to charge a little bit more. They're able to take a look at the company's location by location, so they can look at their profit and loss statements, or how the companies are doing in the specific location that they're renting to. That way they have a better idea for the companies that are going to be their tenants, as opposed to larger chains which won't give that out. Now just look at the dividend growth here. This is something that I like to see too. You can see each year they're increasing the dividends by about 6% or so, 6 to 7%. You can see the 1-year growth rate about 6.4, 5-year growth rate 6.4. This means that they're really trying to increase this over time. And right now, the dividend yield is pretty good, honestly. If you take a look, it's 4.6%. Now, this was a lot higher during the pandemic. You can see here, it went up significantly. And I believe I picked up some shares around here. I might not have known about it at that point. I know for a fact I was buying above 5, and I bought some other companies that were very high too. But this brings up another thing. You can't just buy a company based on their dividend yield. There are a lot of companies out there that are, that have 14%, 15%, 20% dividend yields. That's not a good thing to look at. Now, the reason I say that is you can get trapped into thinking that that's a good way of measuring a company's success. However, companies that give that much typically don't have as much to reinvest in the company. So you can look at something like AT&T. They pay a 7%. And I'd say that's really on the high end of dividends for really stable companies, because AT&T is generally considered a pretty steady company. I mean, it's a very large company, but you have to be careful because they don't have as much money to reinvest back into the business. Companies really don't want to cut their dividends because investors really dislike that. And then with these other higher companies, even higher than 7%, there's a reason that they're paying so much. Either they increase the dividend, and there's probably some reason for that, right? I mean, don't get me wrong, it could be a good investment opportunity, but why did they increase the dividend? Maybe it was just that they had some extra cash from something and they paid out an extra dividend to shareholders. Maybe it's going to drop right back off after that. Or maybe the cost of the stock went down recently because investors are scared about something. So who cares about a 14% dividend yield if the share price goes down 50%? That's something that you don't want. You don't want to get stuck in a company that's going down and hey, you get a nice dividend yield, but the price of the company keeps on falling, and then eventually maybe it goes bankrupt. Maybe they can't pay to their shareholders. Maybe they cut the dividend because there's not enough money sitting around. You have to look at other metrics besides just the dividend yield. So that is kind of a breakdown of some of the stuff that I look for in dividend companies. Now, again, if you want to join me along the journey and see what I'm buying, I give updates every week. Sometimes they get lost because I do them at the end of the week when I talk about all the other stocks that I'm buying and selling throughout the week, but I always update them. If you guys want to know when I buy these stocks in real time, though, and what I buy, you can check out the link down below to Patreon. Again, you can check out the link to M1 Finance if you want to invest in that. Or if you want to start with WeBull, you can check out that link down below too. Thank you guys so much. I really appreciate it. If you want to see a different video on a stock that I've been buying recently that's actually a penny stock, you can check out this video here. Thanks, and I'll see you in this video. Bye.